You want to buy something, but you don't have money. So, you use a credit card. Now, what is a credit card? To understand a credit card, imagine this situation. You want to buy something nice right now because life is good, but you don't have enough money in your account to pay for it immediately. Instead of waiting, you use a credit card. A credit card is a financial tool that allows you to buy now and pay later. When you use the card, you aren't spending your own money right away. Instead, you are borrowing from the bank to complete the purchase. The credit exchange. You, the consumer, the borrower, the bank, the lender, the entity providing the money. Credit card, the tool used to facilitate the loan. Money, the currency, the amount being borrowed and repaid. While this system allows for immediate gratification, it creates a relationship of debt. The act of borrowing carries a fundamental responsibility. Every dollar borrowed must eventually be returned to the bank. The mechanics of borrowing. The 30-day cycle. When you use a credit card, the bank pays for your purchase upfront. In return, you are granted a grace period, typically around 30 days, to repay the borrowed money. If you pay back the full amount within this window, the transaction remains a simple, interest-free exchange. Understanding the credit limit. A credit card does not provide access to infinite money. Every card comes with a credit limit, which is the maximum amount the bank allows you to borrow at one time. Starter limits. Most beginners are issued cards with a limit of approximately $1,000. Trust building. As the bank learns to trust you through consistent, on-time repayment, they may increase this limit, granting you more borrowing power in the future. Once you understand how to borrow, the next step is understanding how the bank decides which people are trustworthy enough to receive a card in the first place. The credit score, your financial reputation. A credit score is a single, vital number that banks use to determine the likelihood of you paying back borrowed money on time. It is essentially your financial reputation based on past behavior, whether you pay your bills regularly, meet deadlines, and stay within your limits. In the United States, credit scores generally fall into these benchmarks: 800 plus, excellent; 740, good; below 580, poor. Borrowing power. A high credit score is the key to true borrowing power. Beyond small everyday purchases, a healthy score is essential for achieving major life goals. Banks rely on this score to approve large loans for important investments, such as buying a house or acquiring a car. Having a strong reputation makes it easier to qualify for a card, but there are several strategic reasons why a savvy person would choose credit over cash. Strategic advantages. Why use credit instead of cash? Using credit cards responsibly offers three primary benefits that cash cannot provide: building history, enhancing security, and earning rewards. 1. Building trust. By using a card and paying it off on time, you build a credit history. This history proves to banks that you are reliable, which is necessary for securing larger loans for your future home or car. 2. Enhanced security. Credit cards are inherently more secure than cash, because the card uses the bank's money rather than your personal cash. Theft protection. If your card is stolen, the bank can stop the thief before any of your actual money is lost. Scam defense. If you accidentally buy a faulty product, the bank will often step in to resolve the issue because their own money is at risk. 3. Rewards and bonuses. Banks incentivize card usage by offering perks. Many cards offer a sign-up bonus if you spend a specific amount in the first few months. Common rewards include cashback or direct currency rewards, points redeemable for hotels, restaurants, or car rentals, airline miles for flights, gift cards for use at specific stores. While these perks are attractive, they can lead to significant financial danger if the card is not managed correctly. The danger zone. Interest and compound debt. The negative side of credit cards is debt. If you fail to pay back the full amount on time, the bank charges interest. Interest is the extra cost of borrowing. The trap of compound interest. Compound interest is a debt trap because the bank charges a percentage of the total debt, which grows every single day you don't pay. While the bank calculates this growth daily, the cumulative effect is most visible in monthly cycles. The 2% monthly growth calculation. Month 1. You borrow $100 and forget to pay. The bank adds 2% $2. Debt is now $102. Month 2. The bank adds 2% of the new total $2 and 4 cents. Debt is now 100 for dollars and for cents. Month 3. The bank adds 2% of the latest total to $8. Debt is now $106.12. Even if you choose to pay only the minimum amount to avoid late fees, the bank will still charge interest. Most of that minimum payment will go toward covering the interest rather than reducing the original $100 debt, making the debt very difficult to escape. Navigating fees and fine print. Beyond interest, there are several hidden costs associated with owning and using a credit card that everyone should know. Potential fees to watch for: setup fees, a one-time cost to get the card started; annual fees, a yearly charge just for the privilege of holding the card; late fees, charged when a payment is missed; ATM fees, charges for withdrawing cash from an ATM; usage fees, charges for going over your limit, inactivity, or using the card abroad. The importance of APR. Before signing up, you must check the APR annual percentage rate. This is not just the interest rate, it is the total yearly cost that includes the interest rate plus certain fees. It is the most accurate way to understand exactly how expensive a specific card will be over a year. Once you understand the costs and the scores, you are ready to master the daily habits that keep your finances safe, the golden rules for secure spending. Credit cards are powerful tools, but they require great responsibility to avoid the pitfalls of debt. To use your credit card like a pro, follow this checklist. Pro Tips Checklist. The 30% rule. To keep your credit score healthy, never owe more than 30% of your limit at one time. Example: if your limit is $1,000, try to never spend more than $300 before paying it back. Track everything. Monitor all expenses daily to ensure you aren't spending more than you realize. Set reminders. Never miss a deadline. Use alerts to ensure you pay the bill on time, every time. Pay in full. Always aim to pay the entire balance every month. Credit cards are not free money. Match rewards to habits. Pick a card that gives bonuses on things you already buy, like everyday groceries or gas. Final insight. When used correctly, credit builds a path toward your major life goals and offers incredible perks. However, it must be treated as a powerful tool, useful and effective, but dangerous if handled without care. Remember, knowledge is power, and financially literate people are stronger.